Hi and welcome to Hedge Fund Manager. I'm Karl-Mikael Syding. Today we're doing a deep dive of Microsoft, and as always we have several sections including screening and finding a stock, but now we've already chosen Microsoft as one of the great tech companies. Let's call it the Magnificent Seven. After technical analysis, after that it's technical analysis, either on the company and on the market or both. After that, we come to the actual financial analysis, the P equals F times V checkup of the actual value and the operations of the company we are checking in on. And finally, we calculate an annual total average compound return. So what you can expect in terms of annual total returns, that's your income, your rent, or your what you make from the investment every year, and that's on a compound basis. So, for example, 15% with interest on interest, compound interest every year. And we finally make our conclusion regarding the investment. Is it worth the risk? Are we certain enough, or are we too uncertain regarding the potential for permanently lower profits than our forecasts? That is what I call risk. Risk is not volatility in share prices, even though they can be indicators of underlying volatility. In any way, risk is a complicated matter, but for me it's mainly the likelihood that my forecasts miss on the downside. All right, let's go to Microsoft. We have already chosen the company, but I have nevertheless gone through a couple of charts. So we have this one from, it's a heat map from Finviz. So in Finviz, you can locate, there's the screener, and here are the maps. And under the maps, you have an ordinary heat map, and you have the bubble map. These are good tools for visualizing a lot of combined data. So for example, you see the squares here are, they show the market cap of the company. So you can see Microsoft and Apple and Nvidia, Amazon, Google and Meta stand out here in terms of size. And when you hover above them, you can actually see the share price development for all the companies within that sector. For example, you can see here Microsoft, Oracle, Palantir, etc., and their one-day performance. So checking on a screen like this, you can very quickly see if we, for example, look here at one-day performance and change that to 1 year performance, and now we can see it's been a very good 12 months for all the stocks in the Standard & Poor's 500. There are a couple of red ones here, companies that have lost value over the last 12 months. They might actually be interesting to check up on and see if we have any fallen angels that might be interesting. Anyway, that's enough for about Finviz right now. But what I checked on Microsoft was on price earnings growth rate. So that is a key ratio, a valuation ratio, which relates the price earnings multiple, for example, 30, to the growth rate in percentage terms. So, for example, 15% annual EPS growth rate. And if you have a PE of 30 and a 15% growth rate, then you have a 30 over 15 equals 2 times PEG ratio. And 2 times PEG ratio is just about where we have Microsoft. You can see here that it's 2.35. That is a bit on the high side, but it depends on a lot of other factors, of course. And perhaps you remember from an earlier deep dive on Apple that they are at, let's say 1.5 times Microsoft. So Apple is at 3.7. The PEG screening is a pretty interesting one, but I want to emphasize that the PEG ratio is a very fickle friend. It can often lead you astray as well. So it's only a complementary or a starting point for an investigation. Here I'm showing PEG ratios for a couple of the largest companies in the world. So all these are the absolute mega caps. They have more than $200 billion in market capitalization. They are between 200 billion and about 3 trillion in market cap. So these are the 50 mega cap stocks. And as you can see here, Tesla and Palantir stand out in terms of both the PEG ratio and the price earnings ratio. So Palantir is at 15 times PEG. It's incredibly expensive in terms of price earnings related to growth rates. So they are growing too slowly or have a absolutely too high price earnings ratio. And Tesla is at 7 times PEG. That is also considered extremely high. If we go to the mid-range mega caps, we notice that we have Netflix, Meta, Microsoft, and Oracle here in the middle. They are all around, as you can see here, 2.5 plus minus 1, about something like that, 2.5 times PEG. What we can say about this is maybe 1.25 is more of a reasonable PEG ratio. For any company, and 2.5 is an expression of how important tech is today and how much passive money is flowing into these companies and making them about twice as expensive as is really warranted usually. But we do not want to get ahead of ourselves. We will check in on the actual valuation of Microsoft soon. And then we have also the lowest mega cap stocks, lowest valued mega cap stocks, and their PEG ratios are between 0.9 and 1.6 right now. So these are actually more or less all reasonably valued from a PEG perspective. So remember, you cannot use PEG only as your valuation tool. TSMC, Novo Nordisk, ASML and Nvidia, they all are included in the lowest rated PEG stocks. So interestingly enough, Nvidia looks kind of cheap in the context of these 50 stocks.